Hi guys, welcome to lesson 4, Trading the Range Strategy. So what's this strategy all about? Well, this is called the FX Trade the Range Strategy, and it seeks to long Forex pairs that are at the bottom of a consolidation pattern within a bigger uptrend, and shorting FX pairs at the top of a consolidation pattern within the context of a bigger downtrend. So let me just explain that in parts, right? So first and foremost, we know that currency prices move in uptrends, downtrends, and consolidations. In other words, they move sideways in a range with a very clear level of support and resistance at times, and that's when we can profit from this range-bound movement of the currency pair. Now, whenever a currency pair is in a range, there's always either an uptrend bias or a downtrend bias. So many people, they just look at the range like so. They say, okay, there's a clear range, there's a support and resistance. So they kind of like buy over there, and they sell over there, and buy over there and sell over there, right? We call that trading the range. And you could do that. But I tend to be more strict on this strategy to only take really high probability trades. So I'm going to explain what I mean by that. First of all, let me show you the first example. And the first example is one where the price is initially on an uptrend, right? So the price is trending up like so. And eventually, it starts to go into a consolidation pattern. It goes into a range, like so, right? So there's a range. So in this case, I would say that this range is in the context of a bigger uptrend. Why? Because before the range happened, it was initially an uptrend. And it is more likely that the trend will continue because of that. Okay? And again, we know that this consolidation pattern is within the context of a bigger uptrend, also because the 50 moving average, shown by the blue line, okay, 50 exponential moving average, is above the 200 simple moving average. 200 simple moving average. Okay? So this is what I call a range in the context of a bigger uptrend. All right? So when I see that, what do I want to do? I want to go long. And I want to go long, I want to buy when the price is at that support level. So I'm going to go long over here. Okay, or go long over here with a target to exit at the resistance. All right, and again, as usual, I want to always risk 1 to make 1.5 or more. So for the trade the range strategy, we don't always risk 1 hour to make 1.5 hour. We could make 2 hour or even 3 hour depending on how wide the range is. So that's what I mean by we go long on FX pairs that are at the bottom of a pattern, consolidation pattern within the context of a bigger uptrend. So that's what I mean by this. Now, the other example would be a consolidation pattern within the context of a bigger downtrend. So in this case, we see it on a downtrend. So the overall bias is down. And then it goes into a consolidation pattern like so in a range. Okay, so there's a range there. And the overall bias is down. Why? Because the 50 moving average, exponential moving average, EMA, is below the 200 simple moving average. Okay, so that's a consolidation pattern in the context of a bigger downtrend. And in these cases, I want to short the FX pairs at the top of their consolidation patterns. So in other words, I see a resistance over there, a resistance, and when it goes up, hits that resistance, I will do a short, a sell, and my near-term target profit or target price is to exit at the support. So again, I'm going to risk 1 to make 1.5 hour or 2 hour or more. So that's the general idea of the strategy. And again, in the next slide, we'll go into the nuts and bolts of the entry and exit rules, and we'll look at many examples so you get familiar with this strategy. Okay? So time frames, again, I trade this on the 15-minute candles. Frequency, anything from 10 to 15 potential trades a month. Average win rate 50 to 60%. Risk to return ratio on average risking 1R to make 1.5R. Of course, and again, there are times when we may get a 2R or 3R depending on how wide that range is. This works on all FX pairs, and again, use brokers with very tight spreads of ideally 1 to 2 pips a maximum. So let's go now into the nuts and bolts of the entry and exit rules of the trade the range strategy. Alright, so let's begin with the long setup entry rules. When do we buy? When do we go long for trade the range strategy? Well, the first thing is we have to see a range, okay? We want to see one of the FX pairs in a consolidation pattern or range. And again, how do you define a range? A range is defined when the price is going sideways, when it's making kind of like the same highs and the same lows. Alright, so let me just draw it for you. So we want to see something like that, right? Price going up, coming down, going up, coming down, going up, coming down. There we go. Right. So the price goes up, makes a high, makes another high, another high. So it's making same highs, right? Same highs. Same highs, same highs, same highs. Again, it doesn't have to be exact. It's not like a brick wall, it's kind of like a fence. So sometimes it may go slightly outside. It may be, sometimes even slightly short. Okay, so always remember that this is known as a resistance level, and it's not a line per se, it's kind of like a zone, right? So always bear in mind it's kind of like a zone. So this resistance tells us that there are very strong sellers that are waiting there to sell to push the price back down again. Yeah? At the same time, we want to see a strong level of support. Okay, so the price goes down, goes to a certain level, and goes back up again, and goes back up again. So we're going to see same lows and same highs, all right, in a very clear range pattern. Now, ideally, we want to see the resistance and the support being tested at least 3 times each, right? So it goes up, test 1, test 2, and test 3. Again, goes down, hits the support, test 1, test 2, and again, test 3. We're going to see at least 3 tests for it to be a reliable consolidation pattern. Okay. Now, the second rule is that we want the 50 moving average, exponential moving average, to be above the 200 simple moving average. This gives us an uptrend bias in the consolidation pattern. So in other words, we want to see kind of like the 50 moving average, like so, 50 EMA, okay, above the 200 moving average. There we go. Okay, so there's a consolidation on an uptrend bias. Okay, so there's a second thing to look out for. Now, we also want to ensure that the support level is above the 200 moving average. Okay, so that is one of the key rules. So you see this support level over here, right? This black line, support level, should be above the 200 moving average, because the 200 moving average is kind of like a very strong level of support. We want our support level to be above that 200 moving average. Okay. Now, the highest probability is when our stop loss is placed below the 200 moving average. Now, it is not a must. It is not a must, but it is a good to have. In other words, for example, if the price is bouncing off here, all right, bouncing there, I'm going to put a buy there, right? I'm going to buy over there, and I'm going to put my stop loss here. Again, I'll talk about where to put your stop loss in a while, but it should be, again, at least 8 pips away from the buy price, okay? So in this case, you can see the stop loss is below the 200 moving average, which is the safest point it can ever be. Because again, the 200 moving average acts as a strong support on an uptrend bias. So when it hits the 200, it's going to protect it from hitting your stop loss. And again, this is not a must, but it's a good to have. And oftentimes when I see that, I tend to like taking these particular trades, right? But of course, the stop loss can be above the 200 moving average as well. I won't blame you for taking that. That is still a valid trade, all right, guys? Next. So again, we're looking at this from the 15-minute candle time frame. As in all my other strategies, I also take a look at the hourly time frame, right? The H1 candles, to ensure that on the hourly time frame, it is also on a clear uptrend. Now again, on the hourly time frame, it doesn't have to be in a consolidation, but it's got to be on a clear uptrend. So again, how do I define that? I define that by ensuring that on the H1 candles, the price of the candles on hourly is above the 50 exponential moving average, and the 50 is above the 200 simple moving average. All right, so these are the setup rules for going long for this trade setup. So where do we place our buy, our stop loss, and our target price? All right, so once I see that specific setup, I would then get ready to put my buy limit order. Okay, now bear in mind that for this strategy, it's different from the impulse pullback and impulse pin bar strategy. For those strategies, I use a buy stop order. Right? Recall, a buy stop order means you're buying higher than the current market price. Right? But for this strategy, I'm using a buy limit order. A buy limit order means you're buying below the current market price. You want to buy at a lower price than the current market. So I tend to use that for this strategy because I have a lot of confidence in that level of support that I put my buy limit order at that support level. All right. So in other words, once I see that the price is hitting support, right? And say it is going for another round, it goes up, okay? And it comes down, and I see that it's going to hit the support level, right? So the support level is, say, here at this point. So what I do is I put my, let me just rub this away, make it a bit clearer. Okay. Okay. So let's imagine this level is 2058, for example. All right, say that's the price level here. So when I see the price is coming down and it's going to hit that support, I have a high level of confidence that it's going to reverse. Again, it doesn't always work, but it works more than half the time, right? So I'll place my buy limit order at that level of support, which would be at 2058. So this would be my buy limit order. So what does this mean? This means that if the price goes to 2058, okay, or lower, it will execute the buy order, and I'll buy at 2058 or lower. All right. Now, as I place that buy order, I would also simultaneously put in a stop loss, and my stop loss can be placed anywhere from 8 to 10 pips below my entry price. Okay, so that's my buy limit, and I'm going to put a stop loss, which is SL stop loss would be, say, at 2050. Yeah. Okay, which would be again 8 pips, at least 8 pips below the buy order. Again, it could be more than 8 pips, but at least 8 pips. So that is known as my 1R, my risk of this particular entry, right? 8 pips away. Now, the other thing is to ensure that this trade has a good risk to return ratio. I must ensure that from my buy limit price to the resistance, again, where's my target price? My target price would be at the resistance level, right? At that resistance level. So this is my target price, TP, target price. Okay, so for my target price, it would be a sell limit order. Okay, and it must be below that resistance level. It doesn't have to be exactly at that resistance level. It could be slightly below that, but not above that. Okay, it's got to be below or at that level, right? So I got to ensure that from my entry price to the target price, I can reach at least 1.5R to make it worth my while. Okay, if I can't get at least 1.5 R, I will not take the trade. The risk to return ratio, it is not favorable. Of course, if I can risk 1 R to make 2 R or 3 R, then that's an even better trade. So minimum is 1.5 R when I'm taking this trade. Okay. Now, like I said, if I can get the stop loss below the 200 moving average, and I may even stretch my stop loss to more than 8 pips, like could be 10 pips away just to get below that 200 moving average. But if it is not above the 200 moving average, it is still a valid trade. I'm just saying ideally below the 200 moving average would be one of higher probability. Okay. So before taking the trade, also check Forex Factory on the major news events that are being released on that day. And as like most of my other strategies, ensure that there's no major news release within the next 10 candles or the next 150 minutes or roughly 2.5 hours. Okay? And there's also no significant resistance levels within 1 hour of the entry price. In other words, when you enter the trade, you want to ensure you can get at least 1.5 hour to the target price, and there's nothing in between that could impede the price movement. So let's take a look at specific examples of this long setup. Okay, so this one you can see the price was in a range, okay, and you can see a resistance over here. There we go. There's a resistance, right? So tested once, twice, 3 times. So you just have to ensure it's been tested at least 3 times to show a clear resistance level. You can see there was a support here, right? Support, support, support. So it tested once, twice, 3 times, 4 times. So multiple times. So that is a very strong support and resistance. That's a very clear range. So remember, that's our first condition, right? Same highs, same lows. 3 times, 3 times. Next, is it an uptrend bias? So again, there's an uptrend bias in this case because the 50 moving average, right, is above the 200 moving average. So the trend bias is up. We're going to go long when we see the price coming down to the support level, all right? So in this case, you can see that the entry was actually here, and this support was tested many times, okay? Now, could you have entered here? Yes, you could. Could you have entered here? Yes, you could. You could have entered there as well. So you can see that when the currency is in a very clear range, you can actually play it many times. You could buy, sell, buy, sell, buy, sell. You could trade that same range multiple times, like wash, rinse, and continue the process, okay? But for this particular currency pair, I only entered at this point because I didn't happen to see it previously. I was busy doing something else. If I had seen it previously, I would have entered here and here and here, but I didn't. All right, I entered only there and got 1 winning trade. I'm pretty happy for that day. Okay, so what happened was I saw the price going up, okay, and it was coming down, and I said, okay, there's a strong support over here. Okay, strong support over here. So I was pretty confident that it was going to bounce. So what did I do? I placed my buy limit order at 7779, which was at that support level. So if the price goes to 7779 or below, it would buy, it would fill that order, okay? Now, so that's my buy order over there. And again, sometimes it may not reach the buy order and it may go up, right? If that happens, then, well, just cancel the trade, okay? So it doesn't always reach your support level, okay? Now, at the same time, I placed a stop loss 8 pips below my entry price. So my entry price at 7779, 8 pips below will be 7779 minus 8 will be 7771. Okay, and just nicely, that support, that stop loss of mine is below the 200 moving average. So I know I've got a very strong support protecting my stop loss. So that again, that's ideal. Okay, so this distance is my 1R, which is 8 pips. Where's my profit target? My profit target would be at the resistance level or slightly below that, okay, but not above that, okay? And my resistance in this case, or rather my target price was 7792, okay? So that was 13 pips. So I'm risking 8 to make 13. That is more than 1.5 R actually. So it's 1.5 R. And so that was a good trade setup. So what happened was the price went down and you can see it hit 7779. So I bought it at that price. And what happened? It went lower, all right? So initially panicked a bit, said okay. But can you see it hit the 200 moving average? Can you see that? Very strong. And then it went up, boom, hit my target price, and it was a winning trade, right? So this was one example of trading a range going long on an uptrend bias. Now, some of you may be asking, Adam, could I have gotten short here? Could I have shorted here? Could I have shorted here? I wouldn't. Because although it's a range and you can say buy there, sell there, buy here, I wouldn't. Because it's an uptrend bias, I tend to want to avoid going against the trend going up. And you can see that if you had shorted here and shorted here, yes, you could have made money. But again, that's in hindsight, all right? Now, imagine if you had tried it here. You say, okay, it's going up, right? I'm going to short it, right? I'm going to place my sell order there and boom, it breaks through and boom, you're losing money, right? And that's why I will not short it, even though it's a consolidation, when it's on an uptrend bias. On an uptrend bias, I only want to buy at support. I do not want to sell at resistance to initiate a trade. But I would sell to take my profit though. All right? Great. Let's take a look at another example. This was dollar yen on the 4th of October. And again, I noticed a consolidation pattern here. All right, you can see a clear consolidation. It's moving sideways. And let's see if it meets our entry rules. So again, we have got the resistance here, tested once, 2, 3. All right, so tested once, twice, 3 times. We've got a support tested multiple times, right? Tested once, all right, tested twice, tested 3 times. In fact, this would be a test as well. So clear range, right? Now, is it an uptrend bias? Yes, because the 50 moving average is above the 200 moving average. We've got an uptrend bias. I'm gonna buy at the support level if it reaches that support level again. So what I did was I placed my buy limit order over here at 9746. Okay, and as it was coming down, I said, okay, if it reaches 9746, my order will get filled. Okay, and where's my stop loss? Again, 8 pips below, which is 9738. Okay, stop loss over there, which again happens to be below the 200 moving average, so it gives me a bit more confidence. Okay, somewhere over there, and my target price was at 9758. Right, so I'm risking 8 pips to make 12. Risking 1 to make 1.5, so that's a good risk to return ratio. And you can see the price came down and it hit 9746, so it filled my order. I bought at 9746, and sure enough, it went down again. So again, sometimes it can keep going down, right? But it did not hit my stop loss. It reversed, boom, and hit my profit target. And that was another winning trade on 4th of October on dollar yen.